Texas Roadhouse stock, ticker symbol TXRH. This is probably my favorite dividend growth stock out there, but is it also in the buying range right now? The stock is up roughly 18% year to date, outperforming the S&P 500, which is up 15% year to date. From a dividend point of view, things look pretty interesting with dividend yield at 2%. But it's all about the growth. 18% growth rate in the past 5 years. On the 4th of May, Texas Roadhouse presented quarter results where they missed on EPS but beat on revenue. For the upcoming earnings, analysts have a mixed feeling. So does this mean that TXRH stock is a buy at current prices? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Texas Roadhouse do? Texas Roadhouse is a restaurant company operating in the casual dining segment. The company's operating restaurant segments includes Texas Roadhouse, Bubba's 33 and others. If we dive in the most recent earnings results, the 4th of May, we see that revenue was reported at 1.1 billion, up 18.9% year over year, which is of course a huge number. Income from operations is up 12% and net income is up 14.9% year over year. So we are seeing a lower net income margin, which is very interesting. EPS is up 18.4%, which is looking really good in my opinion. Comparable restaurant sales is up 12.9% and domestic franchise restaurants are up 13.3%. To me, this is very important since Texas Roadhouse can easily increase revenue by opening new restaurants. But you want the existing restaurants also to grow organically, so this is looking really good in my opinion. Weekly sales is at 148,000, of which 12.8% were to-go sales, compared to 132,000 last year, with 14.8% to-go sales. And of course this number of to-go sales is impacted by the lockdown periods, so it doesn't worry me at all. Margin decreased 53 bps to 15.9% year over year, which is of course also impacted by last year's lockdown periods, but also because of inflation and wage increases. Texas Roadhouse opened 6 new restaurants and 1 international franchise restaurant. 8 domestic franchise restaurants were acquired. The full year 2023 outlook looks pretty good in my opinion, with positive comparable restaurant sales growth including the benefit of menu pricing increases. 25 to 30 Texas Roadhouse and Bubba 33 restaurant openings. A store week growth of at least 6%, but inflation will also increase at 6%. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Texas Roadhouse is a 7.36 billion market cap company. PE ratio is at 27, which could indicate that they are at a premium price right now. Later in this video I will show you my 3 price targets for TXRH, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 4.17 billion, and in this graph we see that revenue went up really nice and steady, except for the lockdown periods, which of course makes sense with most restaurants being closed. Over a longer period of time margins are growing, which is very nice. Of course there was this big drop during the lockdown periods. EPS is also going up in the long run, and after the lockdown periods EPS really took off. Analysts expect 14 to 17% year over year growth in EPS, which is an insane number. To me this looks really good. And for the revenue it's also looking really good. Analysts expect 7 to 12% growth in the coming years. Return on assets is sitting at 19%, which is a great number. Return on equity also looks really good, but the most important number, return on invested capital, is sitting at 14%, which is an insane good number for a restaurant company. On top of that, it is above the 5-year average. Current ratio is at 0.46, which looks pretty good to me. Over a longer period of time, it is between 0.4 and 1.2, which is fine by me. Total debt is sitting at 780 million, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at roughly 156 million. So they can't pay down a big chunk of their total debt, which is something that I don't like. But keep in mind, companies like TXRH issued a lot of new debt during the lockdown periods, so it doesn't worry me at all. Especially because of the free cash flow. To me, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run. In 2019 and 2020 we see a big drop, but after things cool down, free cash flow is up big time again. And another thing that I really love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2%, which is a decent number. Annual payout is at $2.2 and payout ratio is at 46%. I prefer 50% or lower, so right now they have 54% left in cash to buy back shares, pay down debt, open new restaurants and all other things. The 5-year growth rate is at 18%, which is a great number and one of the reasons why I love this stock so much. They have no dividend streak anymore, because of the dividend cut in 2020, which was a smart move in my opinion. And if you take a look at these numbers, the dividend paid since 2011, you see almost double-digit growth every year. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And then here we see that over a longer period of time, payout ratio is always around 50%, which is a decent level. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at historical growth numbers, which is very nice. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare Texas Roadhouse stock with the overall market, in this case the S&P 500. Next to that I added some competitors, Wingstop, Wendy's and Aramark. On the 5-year chart we see that TXRH outperformed the S&P 500 and most competitors by quite a margin. In total, TXRH returned 79%, including dividends. Wingstop had the highest return with 304%. On the 1-year chart it looks pretty much the same. TXRH still beats the S&P 500 by quite a margin, but Wingstop had the highest return with 115%. On the 6-month chart it's pretty much the same story all over again. TXRH returns 19% and beats the S&P 500 easily, but Wingstop had again the highest return with 35%. On the 1-month chart it's the S&P 500 that is the winner here, with most stocks returning a negative number, which is quite interesting of course. So bottom line, TXRH beats the S&P 500 and most competitors in the long run. But is TXRH stock buy at current prices? Well, let's check the 3 price tags that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 9%, 10% and 11% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 6, 6.5 and 7% based on their own current outlook and current performance. I put in 6.5, 7 and 7.5 for the free cash flow margin. For the PE ratio and the price of free cash flow I'm filling in 20, 21.5 and 23. It's a fast growing company with great fundamentals. They are very steady and consistent and management is doing a great job. They are capable of growing at pretty high numbers, so I'm willing to pay a premium for the stock. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now TXRH stock is at $110. I hit analyze and we only see a few green numbers. We have a low price target of $82 to $89, which is a big drop from the current stock price. We have a mid-price target of $101 to $109, which is around the current valuation, and we have a high price target of $123 to $132. To me, the mid to high price target is the most justified. As said before, it's a fast-growing company that is performing pretty steady and consistent. This means that my final price target is in the range of $101 to $132, indicating that they might be undervalued, but it would be great to see lower prices. My final conclusion on the stock is that I really like the business. As said before, they are fast-growing, but also steady and consistent. Management is doing a great job, and one of the most important numbers, the comparable sales, are growing very nice and steady. From a dividend point of view, things look really good, especially the growth rates. From a value point of view, things look also pretty interesting. They are undervalued in my opinion, but I would love to see this stock go under $100. With the next earnings call coming very soon, I think we are heading to an interesting period for this company. Analysts have a mixed feeling about the upcoming earnings, and if the company manages to surprise us, I think the stock will go up big time. On the other hand, if the earnings are somewhat disappointing, the stock could fall big time. And to be honest, I will hope they present decent earnings and the stock will drop because of an overreaction. For now, we can only wait, and that is exactly what I'm going to do. After the next earnings call, I will analyze them again to see if they are a buy. And if they enter the buying area, of course, then I will load the boat heavily. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.